Every type of investment explained. You have $1,000. That's it. That's all you started with. And by the end of this story, you'll either understand how the world actually works, or you'll wish you never learned. Let's begin. Level 1, the savings account. You're 22. You just got your first real paycheck. $1,000 sitting in your checking account. Your dad says, put it in a savings account. So you do. You walk into a bank on a Tuesday morning. Fluorescent lights. A teller who looks bored out of her mind. You fill out a form. You sign your name, and they tell you you'll earn 0.5% interest per year. You do the math later that night at home. $5. You made $5 in a whole year. You stare at the ceiling for a long time, and you think there has to be another way. There is. Level 2, bonds. So you Google it, and you find this word, bonds. You learn that when you buy a bond, you're lending money to a company, to a government, to someone a lot bigger than you, and they pay you back with interest. You buy a $1,000 U.S. Treasury bond, 4% per year, $40 back in your pocket. Not exciting, but safe. The government has never defaulted, yet you feel smart, responsible, like an actual adult for once. But then, your coworker Marcus leans over at lunch one day. He's buying something different. He calls it the market. You ask him what that means. He just smiles. Level 3, the stock market. You open a brokerage account on a Thursday night. Robinhood, Fidelity. It doesn't really matter which one. You fund it with $1,000 and you buy your first stock, a company you recognize, a brand you actually trust. You watch the number go up the next morning. $1,000 becomes $1,040. Your heart beats fast than it should over something this small. You check it again an hour later. $1,021. You check it again. $1,009. You check it again, and you haven't eaten breakfast. That's what they don't tell you about the stock market. It doesn't just take your money, it takes your attention, but you hold. 3 months later, $1,000 is $1,200. 20%. You made what the savings account would have taken 4 years to give you, and you made it in 90 days. So you deposit another $1,000. Level 4, ETFs and index funds. Marcus tells you to slow down. He sends you an article. It's about a man named Warren Buffett. Buffett once made a bet, $1 million, that a simple index fund would outperform almost every professional investor over 10 years. He won. So you learn what an index fund actually is. Instead of betting everything on one company, you buy a slice of everything. The S&P 500. 500 companies. One single purchase. Apple, Amazon, Google, Microsoft, all of it at once. You put $500 into VOO, a Vanguard index fund, and then you don't touch it. You don't check it every hour. You don't obsess over it. You just let it breathe. Historically, the market returns about 10% per year. Not every year. Some years it bleeds badly, but over decades, it compounds. $1,000 becomes $2,594 in 10 years. $6,727 in 20. $17,449 in 30. And suddenly you understand why rich people get richer while they sleep, but you're not patient. You want more. You want it faster. And that's when everything changes. Level 5, real estate. You're 27 now. You have $18,000 saved, and you buy your first property, a duplex in a mid-sized city. Nothing glamorous, nothing special. 2 units, 1 tenant, already paying rent. You live in the other side. Your mortgage is $1,100 a month. Your tenant pays you $950. You're essentially living for $150 a month. You fix a leaking pipe at 11 p.m. on a Saturday. You answer a call about a broken heater in January. But when the month ends, you have equity. You own something real, something physical, something that appreciates. 2 years later, the property is worth $40,000 more than you paid. So you take out a home equity loan. You use it to buy another property. Now you have 2, then 3. The cash flow grows. But so does the debt. So does the pressure. One bad tenant, one major repair, one market shift, and the whole stack shakes. You feel it. That quiet hum of anxiety that never fully goes away. You push it down and keep moving. Level 6. Options trading. Someone in a Discord server tells you about options. You watch 3 YouTube videos. You think you understand. You don't. An option is a contract, the right to buy or sell a stock at a specific price before a specific date. It sounds controlled, precise even. It is anything but. You buy a call option on a tech stock. You spend $400. If the stock goes up, your $400 could become $2,000. If it goes down, your $400 becomes zero, not down 20%, not down 50%, zero. The stock gaps down on an earnings report Tuesday morning, 9:32 a.m. You watch $400 vanish in 4 minutes. You feel genuinely sick, but then 2 weeks later, you catch a trade perfectly. $300 becomes $1,800 overnight. You screenshot it, you post it. People start asking how you did it, and that's the trap right there. One win makes you forget 5 losses. Your account is down overall, but you feel like an absolute genius. Level 7, cryptocurrency. It's 2 a.m. You're deep down a rabbit hole. Bitcoin, Ethereum, Solana, digital assets, decentralized finance, a currency no government controls. You believe in it, or at least you want to. You move $5,000 into crypto. It goes up 60% in 6 weeks. You can't sleep, not from fear this time, from euphoria. So you move more in. Then the market turns, not slowly, not gradually, overnight. You wake up to headlines. An exchange collapsed. A stablecoin depegged. A billionaire's tweet just moved the entire market. Your portfolio is down 70%. $5,000 is now $1,500. You don't sell. You can't sell because selling makes it real. So you hold and you wait and you hope. And some people are rewarded for that patience, and some people wait forever. Level 8, hedge funds and private equity. You can't access this level yet. Neither can most people. To invest in a hedge fund, you need to be an accredited investor, net worth over $1 million, or income over $200,000 a year. That's the gate. And behind it, fund managers are moving billions. They short stocks. They leverage positions. They make money when markets crash. They profit from your panic. Private equity works differently. Firms buy struggling companies, gut them, restructure them, flip them. Jobs disappear. Profits appear. The numbers look perfectly clean in a boardroom presentation. The factory floor tells a very different story. At this level, you start to realize something uncomfortable. Investment stops being personal. It becomes systemic. You're no longer just playing the game. You're deciding what the game does to other people. Level 9, starting a business. This is the investment nobody really talks about. Not a fund, not a ticker symbol. Yourself. You take $20,000. Everything you've managed to save, and you build something, an online store, a service, a software product. The first 3 months, nothing. Month 4, your first customer. Month 7, you're profitable. Month 12, you hire someone. The return on this investment isn't 10% or 60%. It's unlimited, or it's total loss. Most businesses fail 8 out of 10 if you look at the numbers honestly. The ones that survive, they survive because the founder refused to quit on some random Tuesday in month 5 when the bank account had $340 in it and rent was due that Friday. That's the investment nobody puts on a chart. Resilience. Level 10, the final level. You're 45 now. You have a savings account, a bond portfolio, index funds compounding quietly somewhere in the background, 2 rental properties, a brokerage account full of scars from options and crypto, and a business you almost destroyed yourself to build. You've lost money, real money. You made it back, lost it again, made it back again. And here's what they never actually put in the textbooks. Every investment is a mirror. It reflects what you truly believe about the future. It reflects how much risk you can actually handle, not how much you think you can handle when the market is green. It reflects your patience, your discipline, your ego. The people who win aren't always the smartest in the room. They're not the fastest either. They're the ones who stayed in the game long enough for time to do its work. The greatest investment vehicle ever created isn't a stock. It isn't real estate. It isn't Bitcoin. It's time. And you've been spending it this whole video. So the real question isn't what to invest in. The question is, what are you going to do with what you just learned? Because the market opened 6 minutes ago and someone right now just made their very first trade. Maybe it's you. If you made it to level 10, you already think differently than 95% of people. Subscribe, because the next video goes even deeper.